want the best of, it's Brands by Integra. If you want the best of, it's Brands by Integra. I seen.
Okay, here we are again, Brands by Integra Podcast. I say again, even though this might be our first episode. We did have a first episode, but we might make this our first episode because we have the number one guy that I know at Mortgage in NewFed Mortgage, and that's Eric Portnoy. Today, Eric's here with us. He's been with NewFed now for how long, Eric?
I'm coming up on 9 years.
9 years. He is now the National Director of Sales. And he and I have been working together for a while, and it's a treat to have you here, Eric. Welcome to the podcast.
Good to be here. I thought I'd be the first guest, but I was bumped the last time, so happy to be able to make it on this time.
I think you said something like, "What has my life been reduced to?" That I got bumped from your shitty podcast.
I was trying to save you from that. But yeah.
Well, I'm glad to have you here today. One of the best bright lights of our Brands by Integra company is NewFed Mortgage. And, it's just been from 2023 to now, it's been hard. Tell us a little bit about that.
Well, it's been hard. It's been a hard market, as you know, in the real estate end and in the mortgage end. So, and I think as a company, we went through some growing pains. We had, Brian's unfortunate accident, and we had some change in our leadership structure and market conditions, right? All played a part in the 3 toughest years that I'm coming up on my 28th year, and it's the 3 hardest years I've seen in the mortgage industry.
And isn't that interesting? Because I think we all thought that 2009 and 2010 would be historically, as an old man myself. Well, I'll speak for myself. Max is here, children in the room. But I always thought that would be the worst that we'd ever seen from a market perspective. And then COVID turned into the best market we've ever seen. And then this time, this last few years has been one of the worst real estate and mortgage markets in history. And what do you think the difference is, Eric, between 2009 and those tough years and 2024 and 25?
I think, well, first off, going back, I think 2022 said to 2009, hold my beer. You haven't seen anything yet, right? Just 2009 was a walk in the park. I think a big part of that was because there were so many bank-owned properties in 2009 that we created a new niche market, right? Once we started to get our head around the bank-owned stuff and the winterization of properties and who was responsible for de-winterizing it and getting people through, we had a whole niche market that came out of 2009, 2010 that created a bump for us. There was no bump. 22 was as bad as I thought it could get until 23, and 2024 we started to see some light at the end of the tunnel, but it was a train. Because when we started to gain some momentum, they went the other way, right? We saw 6 rate hikes. So
I know, and it's like 2009. You could see, because there's some differences, right? Like in 2009, we had tons of foreclosures. I was a listing agent, so I had foreclosures, and those sold fast, and so it stimulated the market.
And we saw rates go down, right?
Right, but then post-COVID, the government doesn't really allow foreclosures. So you've got a lot of people who, they say, for example, Tampa right now is the biggest foreclosure market in the country. I don't really see any foreclosures on the market. So they're probably being scooped up by these fix and flippers, these, inventory, investors, and buying these things at auction, buying them from the bank. So instead of going to foreclosure, they're buying the notes and then they're foreclosing and keeping the property. So it's really different. There's no stimulation to our industry from the foreclosure side, right? Which was a big thing, which that's something to consider. The other side of it was rates got so low that no matter what we do post 2021, we're never going to see those rates again. I mean, you must have customers all the time who really need to refinance financially, and won't because of the rate that they have.
Well, I think for a little while they were relying heavily on the HELOCs, right? The big box banks were stepping up and giving HELOCs because the equity position was still there. But
Mm.
as we've seen, those HELOCs are a tool only if you use it correctly. So you see people that have maxed out their HELOCs, they have $150,000 HELOC and they have a rate at 3%. And what we've tried to do as a company is show the consumer that the blended rate, if you have
Mhm.
credit card debt at $60,000, that's at 18, 19%. You have a HELOC that's at 7.5, 8.5%, and your mortgage at 3% blended. There's no difference going to a
It's
30-year fixed at that
well, it's
64
actually
or 60, right?
better to
Yeah.
go to a 30-year fix.
Well, it makes
So we're seeing a difference. We're seeing very different times. I do think that we expected to see, a nice kick to the market this year in the spring. And now it seems like it's still happening, but maybe not like that big boom that we thought we would see.
we're at
I think
war with like 6 countries.
I know. Well,
That's
that's
kind of
one of the reasons. Also, I don't think the weather helped, and it continues to be turbulent throughout the country. So like our markets in Texas, I mean, if we're not having blizzards in Boston, we're having tornadoes in Texas and hurricanes in Florida and, and whiteouts in Illinois. So, I mean, I think that, how does weather play a role?
Oh, seasonality has always played a role in mortgages, especially in the Northeast, right? You know what the housing market does between the holidays, between October, right? Halloween to New Year's. I mean, there's nobody showing houses looking to make that move or trekking through the snow. To your point, it's hard, it's difficult to get those home inspectors out, hard on appraisals, right? So seasonality plays a large
It's
part.
hard on closings. It's hard on closings. Like the last 2 months, we as on our real estate side, I thought without a doubt, January and February, we're going to crush last year's January and February. And this January and February, on the last 2 days of both months, we had a blizzard, or at least a very heavy snowstorm. So it's
Sure.
like all those closings now get pushed into the next month. So now I'm hoping March picks up all that extra, right? But
I mean,
who knows?
as a company, 2026 first quarter compared to 2025's first quarter, we're doubling our production, but that's not saying much because 25 was abysmal, right? So
right.
we're trying very hard to not get ahead of ourselves and overshoot the market, but we have seen some improvement in 2026 for sure.
25 was rough. So like, it's funny because in 25, I was like, oh, I can't wait to get to 26. And then 26 came and I'm like, oh, it's, wow, I made it to March 17th and it's, it's okay, but like, I think that's the tough part of the business that we've chosen to be in is that it's very dependent upon a lot of different factors. It's not just like, it's not just your typical, it's not like selling insurance, right? So like when you're in the insurance industry, everybody needs insurance and they all need it every year. And once you have a customer, typically you get that customer for life. And that's not easy. I was going to say it's easy, but then I thought Lauren, my sister, might see this and if she could phone in, she'd be yelling at us. But like, I think it's easier to be in an industry like that, or, it could have been a funeral director. I think that, would have been easy.
I think you're right in the fact that annuity writes itself, right? If you're giving good customer service in the mortgage industry or in the real estate market, our service can be lights out. If somebody's an eighth lower nowadays, people are shopping, especially with home prices, right, to save that eighth. If you want to list a house at 2.5 and somebody's willing to go out there, we've seen it. There's the bottom.
You mean it's like price? It's like price driven. And I never understood that because I got to be honest. I've gotten a lot of mortgages in my life, And I never really looked at the rate until I got to the closing, because my thing was, and I've never done a loan with NewFed, right? Because I don't know that,
You don't
that
want
I
anybody
ever
to see your
could.
financials,
I don't think
boss.
anybody, I didn't want anyone to see my
We get it.
financials. No, I think it had to do with being an ownership, that you don't write your mortgages where you own a mortgage company. But the funny part is that, like, I always worked with, you know, people who I knew, who I liked, and who I trusted. And to me, I never would get an online loan, like, ever. Like, why would you get an online loan when you can have someone with brick and mortar in your market that you can drive to their office and you could sit down with them at a table and talk about strategy on how to best leverage the investment? I just think it's crazy that people will leave service for an eighth of a point. It makes no sense to me.
We talk about it all the time in just localized, right? I want to do business with people who know my market, who I can see. But there's, Max, who's on the call, his generation, they're buying cars without test driving a car, right? So when I started, I was probably meeting 86% of my clients, 87% of my clients, because we were still doing some online stuff then, or over the phone, and we wouldn't really meet until closing. Nowadays, I don't think Danny, who handles my personal production, I don't think she's met with a client in person more than 4 times in the last 4 years, right? It's just, we've become such accustomed to not seeing each other and not having that it's becoming.
But I still think it's different, right? Because, like, if you go like through, any of the big houses like Zillow Home Loans or Rocket Mortgage or G-Rate or whatever, all these call center style mortgage companies or mortgage banks or whatever you want to call them, I just think that the level of service, like, every time you call in your file, you get a different person.
Agreed.
Like, I mean, I would lose my mind. Like, when I did my house down here, I worked with a great guy. He was from Boston, but he lives in Florida now. He's at a local bank, and, like, he, like, calls me all the time to check in. Like, he tells me, like, hey, the rates are going down. The rates are, maybe it's a good time if you want to do something different with the house. Are you looking to sell? Are you looking to buy anything else? Like, I know that, like, he's also looking for ways to get referrals. But at the same time, when I have a question about my bill or my statement and my escrows and things like that, like, he steps up and he finds me the answer. He doesn't make me wait on customer service for 2 hours. He calls and then he calls me back.
It's only in our industry. If God forbid you needed a surgery, you're not shopping for bargains. If you need a kidney, right? You're going to where you feel like, right? You want to be able to go to the very best kidney specialist, right?
I got a guy that'll do it for free.
Yeah, and with mortgages, I mean, they'll take more time to get to qualify a bricklayer who's laying down a walkway in their house, which they should care about, but they'll take more time vetting that person than they will the person from Rocket, from a completely different market that they can't go by and key scratch their car if they screw them out of their mortgage.
Yeah.
They'll spend more time vetting the guy who's doing their walkway than they will who's doing their mortgage. And that to me is still crazy. And that's where I think, circling back, that's where I think where Lauren in insurance has it over both of our industries is because, that annuity, they're locked in. And as long as you're providing that service, generally, if they're doing what the person from your local bank is doing, and they're saying, hey, we're watching this, we can get you a lower rate, then that person's already set up.
Right.
That's our biggest challenge.
But see the difference, right? If she sells an auto policy to you and you renew that auto policy for the next 100 years, she probably makes as much off of that auto policy as you make on one loan for her house. So that's, I think, that, right? Lower risk, lower competition, lower, higher retention client-wise. I think that's why the commission structure in all of these industries is so different. I mean, why do you think agents now, like back when I started, agents' splits were, 50-50. That's just the way it was. We paid for the Boston Globe ads and all this stuff, right? And now time goes on, and the agents are now the boss when it comes to how the money gets divided, which is fair because things have changed. The house now does different things. We still do a lot of things, but I would say advertising, which used to be the biggest expense, is probably now, I wouldn't say it's the lowest expense, but it's not as much, nowhere near what it used to be. And a lot of companies are now feeding off of this virtual officeless system, which I disagree with. I think that you need offices.
I think brick and mortars in localized.
Well, you need a place for people to come in and go to work, because at the end of the day, I mean, as much as we all would love to say we're going to stop using paper, you still need to print. People still want to hold a listing sheet. You still have to have color printing in the office for marketing materials, and you still need to have some camaraderie in the office to otherwise you're a cultureless, system, and basically you're Planet Fitness. And if I want to go to Planet Fitness, great. If I don't want to go to Planet Fitness, great. And some people are going to do really well at Planet Fitness, and some people are going to stay out of shape at Planet Fitness. And there's no, it's not like joining one of these elite training clubs that, they're really going to help you get, and achieve your goals. So I compare it that way a little bit.
And I think,
same with mortgage.
I think in mortgage, I think the biggest challenge we're having is a mortgage company like NewFed, where we retain a small portion of our loans but sell the servicing. Our servicers are poaching our clients, right?
Oh, I know.
So not only do we have to go and get the client, but then we have to make sure that we're staying on top of the client, because the person that's now servicing the loan is constantly trying to poach our client from us. And our biggest challenge with margins and being able to still be competitive and pay our loan officers is the services have guys answering the phone that are working for, maybe $200 a loan, literally $200 a loan. But I'm left to compete with that with guys that are, feeding their family off of 2 loans, 3 loans a month that they're closing. So it's
right.
It's that balance that we've seen in 2026.
Well, yeah, they're paying they're paying a low hourly, and they're basically, you're probably getting a more qualified person at the deli counter.
Well, I would agree, right? I would agree, but it's that ease, it's that convenience. We have all your documentation. Well, so don't we, right? But it's how do you stay in front of that consumer before that servicer gets your consumer? How are we staying in front of them? And that's where the marketing, and that's where our challenges have come in.
Well, that's a challenge of the mid-size independent mortgage banker. I mean, that's one of the things I learned over the past 3 years is that the independent mortgage banker does 70% of the loans nationwide and has the biggest uphill battle to do loans because all of the chips are in favor of the banks. All of the regulations favor the banks. Everything favors the banks. Yet we, as independent mortgage banks, lend 70 to 30% of the loans for homebuyers in this country. That's a huge story right there.
I tell everybody that'll listen, what's the best part about NewFed is we're a mid-sized family-owned mortgage company. What's the hardest part about NewFed? We're a mid-sized family-owned mortgage company, right? So,
yep.
And I would still take the type of business we do with the consumers we get, with the cultures we have here, over any of the big box lenders.
Yeah, the wins are awesome, right? And the challenges, they suck. But at the end of the day, we are helping a lot of people. And I think that's really why we all get into this industry, is to help people achieve the goal of home ownership and make their lives better. That's really what we're about. So we do it with loan originators and agents and our employees. And, there's a lot of people that rely on NewFed Mortgage and our Century 21 offices and our CB offices and, all of the companies, our property management companies that rely on these companies to provide for their families. I mean, we are literally helping provide for over 2,000 families.
And
How awesome is that?
I always say it, especially about NewFed. My customer is my loan officer. My manager's customer are their loan officer. Because if you take care of your employees, they will automatically take care of
the
customers.
consumer. And that's what I said. The same thing with the real estate. Our agents are the customers, and the consumer is their client.
Correct.
And yes, we're here to back that up, and we will help any consumer in need that calls. However, you're right. That's who we cater to nowadays. Where back in the day, it used to be all to the consumer.
Well, it was direct. It was,
And what's interesting is that the big boxes cater to the consumer
100%.
and not the originator. Yeah.
Correct.
So
Correct.
it's literally the opposite.
Yeah, well, yeah, that's that balance that we're always trying to create with a company our size. How do we maintain, how do we retain our best loan officers and pay them well enough that they want to stay, but still be able to pass a benefit off to the consumer? It's the biggest challenge in managing a mortgage company.
Eric, do you think direct to consumer will help with that?
I think there's a platform for direct to consumer. I think we're actually timed right, because I think regardless, not to get into a political statement, but regardless of what's going on politically, I think it's been assumed that rates will cyclical and they will come back down again. I don't think they're going to stay where they are. And if you see, a 1 point drop to rates, whether that's over a 6-month period or a 12-month period, direct to consumer and being ahead of that curve and being set up for it is a smart business tactic. But, again, the meat and potatoes of a mid-sized mortgage company is always going to be realtor driven. I think in my almost 30 years, everybody's told me how they're going to revolutionize the mortgage industry, and they're going to get the divorce attorney, who's a great referral source, or they're going to go after financial planners. Again, great referral source. Today, the number one referral partner for a mid-sized mortgage company is their direct relationship to their realtor partners. I know that my success in this business has run parallel to the success of the Nydia Pegueros or Peggy Perkins, the people that have given me loans throughout my career, and that's always been my bread and butter, right?
When I started in the industry, my first 2 loans went to Rennie Alexander. I don't know if you know Rennie, and Tom Travers.
I know Tom.
You know Tom. So when I started in 1992, 22 years old, and I was trying to learn how to write an offer because we didn't have dot loop. You had to write the offer. It was on a 3-part form, carbon copies, and all that good stuff. And I was trying to create a template for the dates because, X amount of days for the home inspection, X amount of days for the commitment, X amount of days for this. And I think it was Tom Travers that helped me plug in all of the kind of like the templated, like 7 days from that date is this date, those types of templates that we needed back then. And, my very first loan I gave him and he couldn't do it. So I went to Rennie, who was more like, he was more, in the programs that catered to that first client that I got at 6:00 on a Sunday night because I was stuck at the worst uptime shift in the office. And and it was it's so crazy. Like the real estate agents, especially when they're new, the mortgage partner that you first team up with leaves a lifelong impression on your business. I mean, some of those old guys, geez, I learned a lot from those guys. And now we're one of them. Well, I'll speak for myself.
The mortgage person who broke me into the business, Don Cardell, I went to work at Coast.
Oh, yeah, I know Don.
So Don Cardell, he broke me into the business, and I was like a sponge. I would just hang around his office all day long. He said, I don't know how to train somebody, but if you want to come in, you can listen to me. And it got to the point when I would take an application, I used his exact cadence where he would make the same joke during the application. I would make the same joke until I heard myself say it for like the 15th time. And I was like, oh, I got to get my own.
Funny.
I got to get my own script here, you know, but yeah, it does. And I never forget that. He used to, back then, remember, we had to handwrite everything, right?
Handwrite everything.
Right. So you'd have to write in and that was the 80-20 days. People would have 3 pages of credit and you'd have to write in the credit. So you learned how to print, because if they couldn't read it, they wouldn't work on the file.
Right.
And Don used to take a yellow highlighter and give it back to me. And then I'd go back and I'd make the changes, and he'd go with an orange highlighter, and he wouldn't let me turn it in until I got back. And to this day, I thank him for it every time I see him. Right.
Yeah. I mean, those days, it was tough to put a deal together, and the average sale price
to take
so
applications
low.
on Essex Street, right? The dog would be running around, 13 kids, no coffee table, sitting with it on my lap in the living room, writing it out. Yeah.
On Essex Street in Chelsea.
Yeah. Selling 18%.
Was it a D'Amico? Was it a D'Amico property?
Yeah, like your father's always been good to me. He'd say, if you can get the mortgage, I'll give him the last month off. Tell him.
Oh, that was nice.
So, yeah, he's always good to me.
No, he's so I mean, we both kind of I started my career in Chelsea. I didn't grow up in Chelsea, but you grew up in Chelsea. And little known fact, when I was like 22, 23 years old, they were doing a story on Chronicle, the after news show about different things in New England, and they were doing a story on Chelsea's comeback and the real estate market. And this is back in 1993, I think, or maybe 94. And they came to Florence Lip's office and they said, we want to interview Diane Cambria on Cottage Street. And Diane wouldn't do it. And she said, you do it. And I said, I'll do it. I want to be on TV, right? So I went up to Cottage Street and they interviewed me and your mother, who was I think the president of the city council. So what was that like growing up?
It depended on where I walked in and how they felt about my mother's political stance. I could go from not having to pay for dry cleaning to being thrown out of the same place next door. Right. So it just, but for me, it gave me a foothold into this business. I started to buy some real estate and in Chelsea, and then I was working for the highway department. The joke is nobody leaves a state job, right? I had a state job. I was buying 3 families at the time, 130,000 turnkey. You buy them on Friday, tenants go in on Monday. I mean, it was good. It was good back then. And I remember I went on a vacation, and back then you had to use the fax machines, right? Because they had the business center. So I went on vacation, and I remember I said to I had to go to the business center. They faxed me over a HUD to look at. Johnny Amatola was my mortgage guy at the time.
Oh, God.
Oh, yeah.
I remember Johnny.
So Johnny
He's still
Amatola was my
around.
mortgage guy. And I remember I was on a vacation, and I said I was dating her, but now my wife, I remember saying to her, look at what this guy made. Look what this guy made on this deal, And she was like, yeah, all right, we're on vacation. Enjoy yourself. I'm like, I can't enjoy myself. This is making me sick, right? And I said, this is what I'm going to do when I went home. And it just so happened they moved me to a night project. And they moved me to a night project. They said, you're going to go to nights. And I said, no, I'm never coming in again. And I remember coming home and my mother saying, you know how hard I had to work to get you a state job? Uneducated moron, what are you doing leaving a state job? I said, I'm leaving, I'm going to do mortgages. And that was my start in the mortgage career.
Johnny Amatola with probably had ink all over his sleeves and
my mother had
cigarette burns in his suit jacket.
Yeah,
I remember those days. Johnny did a lot of loans for me. He's a good friend back then. I just ran into him not too long ago. I was at something and I ran into John. I haven't seen him forever. And then I saw him recently within the past year. But yeah, it's funny going back in time because back then, I'm sure you feel the same. You'll agree with me on we didn't know what we didn't know.
But that was good. You were
Yeah,
fearless. I think
fearless.
now with his educated, I remember Richie Clayman. My first office was with Nydia. And when I first started in the mortgage business, between my mother and Richie, they really gave me the foothold in Chelsea. And Richie would say he's a defense attorney in Chelsea, and people would come up and they'd need money to defend their kids. And he'd say, Portnoy, this kid, he'll put a mortgage on the picture frame. He doesn't care what you need a mortgage on. He'll take care of it. And people trusted Richie, so they automatically trusted me.
Yeah.
But I say to Max all the time, you have it so much harder than me, because the consumer at their fingertips is so much more educated than they were. I didn't have to worry. I went into every meeting assuming I knew more than the consumer I was meeting with. Today, if you're starting out, that's not.
I think it's going to be,
right?
I think it's going to be tough. I mean, listen, I'm sure that the guys that came before us probably said, I don't know how this generation's going to do it, right? And look, here we are, and we don't know how the generation behind us is going to do it, but I'm sure that the 20, 30 years from now, they'll be telling the same stories. I mean, they do have some huge benefits. Imagine if we had Google, I mean, imagine
if you stay in front of it like Max is with the AI tools, and that's where the business is going, right? The business is, I'm not going to recreate this wheel at 52 years old, right?
No.
Well, Max is already starting to recreate our wheel at NewFed, and the way we're looking at contacting the consumer, and even in a 3-year period, where we were 3 years ago on how we would proactively market to our consumers has changed in 36 months completely. We've done a 180 and it's completely different, right? We all used our LOS system as our tool, as our Bible, and that was what you used, and you went after and you made those calls and you reached out, and now what would take us hours, we're doing in minutes, right?
Well, there's a lady at a big box lender I know of. She has a YouTube channel where all she posts about is personal finance. And the whole goal of the YouTube channel is to funnel people to her website. She does pre-approvals from there. She did over $200 million last year.
Right.
Wow.
That's the way it's going. You
Well,
have to be active on social media. We were talking earlier about the big box lenders, and they're always in front of us, right? You just go on the Super Bowl, you see how many Rocket Mortgage commercials.
Oh, yeah.
That's what it has to be. You have to be in front of everybody.
Well, it's true.
The good news is this. Here's the part that's the good news. Same for the real estate industry, right? So you look at the big box mortgage, or you look at the, back when we started, there was like 4 or 5 different brands of real estate companies. Now there's like 400 or 500 different brands of real estate companies, and all that's really happening at this point, there's only so many real estate agents. There's going to be only so many independent mortgage bankers. And we're going to be one of them, right? And we're going to be one of the brands. And we're going to be one of the independent mortgage bankers. And I used to always say this. People would say, oh, the market's terrible. Okay, so we sold, and I'm just making up numbers because I don't even know what the numbers are, but we sold the 3 million houses nationwide in 2025, and we sold 1 million houses in 2026. Okay, difference is 2 million houses, right? Well, if our company sold 5,000 houses, we can still sell 6,000 houses. That number's under 1 million, right? So whatever that number is, we just have to stay focused, keep our blinders on, and get from that 5,000 to 6,000 mortgage, get from 2,000 to 3,000. Like, how many mortgages do we need to do to be successful? And then I think if you're an individual producer, it's based on, say I sold 50 houses last year. Can I sell 52? If the market goes from 3 million home sales to 1 million home sales, can I still sell one more house?
Well, that's been our mantra on the NewFed side for the last 3 years, right? We don't need you to go from being a $20 million producer to being a $40 million producer. What we need from you is if you did, you did 60 transactions, can I get 65 out of you, right?
Right.
It's exactly. But to touch on something you said, I have a question for you. So brand recognition, right? There's so many more companies out there, so many more real estate companies out there. So I think that our employees are truly our ambassadors. They're pushing our brand out on a regular basis to help get our name out there. So how do you feel? We've seen it in mortgages and we've seen it even more so in real estate. Everybody are developing their own teams, right? The D'Amico team at Century 21, the Furman group at Century 21, or the Pratt. And how do you feel? Do you think that's, as long as that's Century 21 or as long as that Integra is tied to it, do you think you're still getting the brand recognition out of all of these people creating their own teams?
Well, I think it's changed, right? So back in 2010, when I thought I was going to go out of business and I was like, I'm done. I don't even want to do real estate anymore. I was completely defeated and I had nothing but debt and I couldn't keep the lights on in the 9 offices that we had. I decided to start selling houses. And I said, because I used to sell houses and then I took that time off and we built the company up to like 20 offices and we were #1 in New England. And, I was in my, literally I was like in my 30s and I thought I was king of the world. And then the market crashed and I got humbled very quickly. And I was like, well, I know that if I sell houses again, I could probably bring in enough money. So I knew that I couldn't do all the paperwork. I wasn't good at that. So I recruited a couple of our agents to join my team. And I said, you'll be on my team. There were no teams back then. It wasn't like, there was, but it wasn't like it is today. And we created the D'Amico sales team. And we ended up with towards the end, there was probably like eight or 9 people on that sales team. And we killed it. We did great every single year. It was me and Domenica and Adrian O'Keefe and even Richie was on there for a little while. And so I had a really great sales team. And when we got into the 2010, 2011, 2012, I started, when I was recruiting top agents like Michelle, I talked about them building their own office. What I didn't realize was I was convincing them to build their own team. So I brought Michelle and I went partners on the North Andover office back in 2014. And actually, I think it was even earlier than that because originally we were above the Andover House of Pizza. And then we moved to a new office in 2014. So we've been together a while. Same with Peggy, same with Nellie. And, all of the focus at that time was come on with me and we'll share an office. We'll recruit agents for the office. You'll recruit agents for the office.
So almost as a split cost, that was
almost like a P&L branch in a mortgage company.
Yep.
And, quickly realized that the branding of the team was going to be important because, we all knew back then, right? Lillian Montalto, the big names back then, they came across as individuals, but they were really teams like Donna Ligotti from, Joyce Cucciara, but they had people around them that helped them. And so it just shifted from being that individual agent on the bus stop bench to the teams, right? Because they were in the shopping carts and they were on the benches and they were on the billboards and all that stuff. To answer your question, I don't care, truthfully, I feel like our brand today is our reputation. People will say, Peggy Pat Group, and they'll look at it and they might even say, well, which company with? Oh, I'm with Integra. I'm with the Century 21 Northeast. I'm with Brands by Integra. Oh, I know that company. So I don't think that our brand is as important when it comes to that. On the mortgage side, I do think it matters. But I always feel like it's our service, right, that matters more. Because if your service is good, no matter how much you advertise, when your service is good, people come back.
I think what's been eye-opening for me, especially in the last 3 years, is production doesn't necessarily equal profitability, right?
Oh,
And I think
yeah.
you just touched on that, right?
Yeah.
And I think for anybody leading a sales team, no matter what the size is, ours is large, right? For a mid-sized company, I think if you're in sales, production is the way your mind just automatically thinks. It's the reason why you're in the position you're in. It's to drive production. And to really have to focus, the last 3 years has made me focus on more retention than production, in retaining the right loan officer over the highest producer, right? Because we had somebody out of College Station that was one of our largest producers, but didn't fit our culture
Right.
or our profitability pattern. And you couldn't convince me 2 years ago that it was going to be smart to let that
To let
person go.
production go.
Yeah, because
Same. Listen, same.
I'm holding on to it, with dear life, especially the last 3 years.
It's so funny. 2024, we lost 10% of our overall gross production. We lost it, like right by the end of the year, we lost. And I was beside myself, and I kept saying, well, I mean, I don't think I can sustain what they're looking for. So let's see what happens, right? So I've said to myself, okay, well, if we're going to do whatever the number was, let's say it was, we're going to do 2.8 billion, or we're going to do 2.5 billion, right? And so I was like, okay, well, we might sell 2.5 billion next year. And I guess I'd be okay with that if we're more profitable. And then what ended up happening was I think it was like midway through the year, we lost 10%. We were only down like 2%, and we were up like 100% profitability. And so that, to me, I mean, it's still a low number, but 100% sounds good, right? It was, we work on a thin margin, right? All of these businesses operate now on a very thin margin. Back in the day, these companies made 10, 15% in profitability. Now you'd be lucky to eke out 1%, 2%, 4%. Those numbers are real. Everyone thinks that we're making bank, but the reality is companies have to work on thinner margins. It's the Walmart effect. It's the Amazon effect. It's more volume for less profit, and that's what you have to do. So you have to scale. So everything's production, but production becomes, what's the word I want to use? Certain production is production that you don't want. It's like,
Well,
it's not going to contribute. It will pull,
drain more resources.
it will drain
Yeah.
your ability to eke out your 1 or 2%. It will take that last remaining 2%, and you might gain an extra 100 million in production, but you lose another point on your
How do you guys
profit.
measure that when you're recruiting and bringing on new groups?
I
On a
mean, you have
mortgage-
you look at a 12-month run, that's easy, right? If somebody's been here for 12 months, I can figure it out like that.
Yeah.
The thing is that everybody in these industries comes with a cost. And so, are we losing money? Are highly productive people, when they get beyond a certain point? Or are we losing money on the, 400 realtors that sell 1 or 2 houses a year, right? And so, like, that's the thing that we're always looking at and trying to figure out, well, how much of our resources are we actually spending on someone that sells 2 houses a year that we don't see as much than the person that's in every day that sells 100 houses a year? It's always like trying to figure out that thing, because the resources for all these companies based on overall contract price, so contract price, per user price, those types of things. It's really tough to figure out. But I will say that when the most important thing, I don't care what business it is, I don't care how much money's involved, culture is the most important thing. And one thing that I can tell you that's easy to measure is if the person drains culture, they're also draining profit. Without a doubt.
Good point.
There is no doubt in my mind, if a person's going to come in here and drain our culture and not buy in to what we are all about and complain and, make a problem with everything that they do, because when I was over here, we did it this way, you will absolutely be losing money on those people. No doubt about it.
And I think the other variable in mortgages is product mix, right? So when you look at mortgages and you see somebody that does their average loan size is $1 million and they're just handling jumbos, you would automatically, if from an outsider looking in, you would say that person has to be way more profitable than the person whose average loan size is 350.
Right.
But with loan officers, if their product mix is more FHA than it is conventional, which you'll learn in Max, right? You can do less, but be more profitable as a company. And I think that in a managerial position, in talking about culture, that's the importance. When I'm on calls and I have a mix of salespeople on the call, I make it a point to make sure that everybody, hey, that jumbo guy that's out there and they're doing $1 million, that's ultra important to NewFed. They're driving into a market that we might not necessarily be in. But Nolas Espinal, who's gonna have that average loan size of 650 doing multifamilies in Lynn and Chelsea, you can be Nolas all day long, right? I'll challenge anybody on that call because the client base, the referral sources, those people don't leave overnight. They're sending their cousins. They're sending their and that jumbo play is only as good as that one loan.
It's the first time home buyer market. It's my favorite market. It's the only market I ever focused on as a realtor. I like the first time home buyer market because the people appreciate it. They come back to you and they bring friends. And that's just the best market, I think, in this industry.
Wage earners, first time home buyers.
Yep.
Is where this business is won in the trenches every single day. And I tell that to everybody. You bring me that guy that's making their living or that woman that's making their living in that jumbo market. I know what I'm getting. I'm not saying no, but I know what I'm getting, right?
We've had a few. Person. I've sent you a couple. They're not easy.
No, you send me that person who's right out of the academy, becoming a firefighter, a police officer, a nurse, EMT,
military,
or working in a hospital, doing maintenance, a plumber, right? Those are the people. Those are the people where you do, mortgages for life, right? Every stage of your life, our tagline. That's where Brian built this company off of, and that's always been the meat and potatoes of mortgage.
That's because he built it that way because that was my customer base.
There you go.
I'm just kidding.
We got to follow somebody's footprint.
Yeah,
we might
exactly.
as well follow yours, right?
I don't think he did, but I'm just teasing. All right. Well, this was awesome. And I want to thank you for joining us. I think we're definitely going to have Eric back because this was really great. And I love the dialogue. And I'm hoping that people will tune in and maybe learn something. Eric and I are always available to you if you're interested in learning more about mortgage, real estate, or if you just want to, talk about sending over some clients that need help with obtaining a mortgage, refinance, purchase, you name it. We're in 28 states with NewFed Mortgage now?
And we just applied in Ohio, Indiana, and Kentucky.
Beautiful.
If you ever told me I was going to have to go to Kentucky for anything but the Derby, I would have laughed at you.
Well, we can go to the Derby now. We'll have to go to that. But anyway, so thank you, Eric. Thank you, Max. And we'll see you next time on the Brands by Integra podcast.
Thank you for having me. This was great.
No problem.